In this week's video, we'll show why, from a chart and model perspective, it's easy to say that the markets are maintaining a bullish bias. We believe it's important to focus on what is happening in the markets rather than what you want to have happen or what your current forecast is. And what is happening is bullish. Topics for this week's video: we'll dig into what the CCM market models are saying now from a risk and allocation perspective. We'll look at global ETF leaders and talk a little bit about where we are and where we may be going. We'll look at the big picture of the markets from a daily, weekly, and monthly perspective. Answer the question, what is breadth telling us currently? And we'll close the video with the CCM Big Four charts. To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is the master spreadsheet for the CCM market model, and ultimately what the models do, and the master model tells us what's a prudent exposure portfolio-wise to have to risk, and what's a prudent percentage exposure to conservative assets. As of the close on Friday, July 26, the answer to those questions were 96 on the risk side and 4% on the conservative side. To oversimplify it, if you are asking binary bull-bear questions, 96% of the questions roughly are coming back with a bullish answer. This part of the master spreadsheet takes the individual model scores, correlation model, risk model, 80/20, and the BMSI, and calculates the recommended exposure from the step-in model and the step-out model. And how it does that, it looks at the current market's profile based on these numbers, and then if you scroll down here, it just asks a lot of questions comparing the present day market to historical markets. For those of you that have been following us for a long time, if you want to get an idea of how all these models tie into the master model, you can go to our website, shavacocapital.com, and then look in the left-hand margin and go down to Bull Bear Index and click on it. This is the page for the Bull Market Sustainability Index, and you'll see this flow diagram here that will answer that question. How does it all tie together? Basically, the trend override model, which is the model that's based primarily on moving averages, comes up with an allocation in isolation. The correlation model that we'll look at in a few minutes also works in isolation. Both of them feed into the master market model on a weighted average basis. Then when you look at the risk model, the Bull Market Sustainability Index and the 80/20 Correction Index, the risk model feeds into the master model in isolation, and it also is used as input to calculate the equity step-in model and equity step-out model here. The 80/20 and the BMSI also are used as inputs and calculations for the step-in and step-out models. Basically, what the step-in and step-out model do is they take the risk model score, the Bull Market Sustainability Index score, the 80/20 Correction Index score, and compare the present day to historical market profiles, and then suggest an allocation based on the risk level of the present day relative to history. Before we take a look at the current scores for the weekly correlation model, let's just do a little refresher on what goes into that model, especially for those of you that are new to the fold. This is one of the charts that feeds into the correlation model. This is risk on longs relative to risk off shorts. So this is the ratio here of the S&P 500 relative to shorting the S&P 500. And what the model does is it answers questions about price, these moving averages, and all of these indicators, and it weights them according to their value in terms of helping us track and predict the most important thing, which is price. So price itself and these moving averages, which are closely tied to price, carry heavy weights. The indicators carry various weights. Now, if we were just looking at this chart in isolation and these indicators, it would be very, very difficult to take all of this and make a rational decision. Now, if you add in that the model also follows all of these charts, and every chart has a list of indicators weighted accordingly, it would be nearly impossible to scroll through these charts every day, look at that many indicators, and make a decision on what to do. The model does that for us. This is the master spreadsheet for the weekly correlation model that feeds into the master market model. Here are the list of charts that we just looked at, including the CCM Big Four that we review every week here to get a broad brushstroke of what things look like. The model takes all of the charts and all of the indicators, answers questions about them, also takes data. There's a threshold component to the model, and then it comes down here and performs all sorts of calculations, weighting it. And what it does is it takes all of that information and it boils it down to one score that we can make a decision off of, and it enables us to compare this score to historical market profiles. The current score, as you can see, as of the close on Friday, July 26th, up here where the cursor is, was roughly 94. Again, telling you that if we were asking binary questions, which we're not, the model it's not based all on binary questions. Some of it's based upon the mathematical thresholds. 94% of either the thresholds or the answers are coming back bullish. And you may ask, well, that means we're overbought and about to reverse. Not necessarily. You can have a number like this and the market can go up for 1 to 3 months easily with this type of profile. The way you should think about it is markets can advance when they're in overbought territory. It's when they come out of overbought territory that your concerns would increase. The big picture, technically, is bullish. We'll move on to charts after a quick look here. We just want to keep updating you. The last 2 weeks, this is the big backtesting project. This backtests all of these models going back to 2003. And what it does is it compares the CCM master market model to holding the S&P 500 in the form of SPY. So you're looking at total return versus buy and hold total return. This assumes you have one commission. You buy once in early 2003. You hold all the way through and have no trading costs and no management fees. This assumes that you run the models, you have trading costs, and you have management fees. The purpose of showing it, all of the models, the risk model, step in, step out, override, correlation, all of them in isolation beat SPY, buy and hold. They all add value. 2 weeks ago, we showed the override model beating the S&P 500 if you just used it in isolation. Last week, we showed the step-out model. This week, let's look at the step-in model in isolation. And how we do that is we just change these weights. I don't want to use the step-out model anymore. You'll notice the numbers will change. Now I'm going to a full master model weighting using only the step-in model. You can see the long-term results for the step-in model outperform SPY hold significantly. The average annual return for the step-in model is 10%, SPY is 9%, but this is the big difference risk-wise. On a risk-adjusted basis, this number blows away this number. Why? The maximum drawdown for SPY over the period is 55% roughly, and the maximum drawdown if you followed the step-in model in isolation was roughly 7 to 8%. The master market model weights all of these and uses them all. The point of doing this is to show that they all add value and they all beat SPY buy and hold. To give you a moderate example of what the backtesting project looks like when you use all of the models, we can go to this scenario here. You can see under these conditions, we're weighting the models in this way. They all have input. This is the master CCM market model here versus the S&P 500 here. You can find all of this information on our website by looking at the portfolio models in the left-hand margin. We'll kick off the charts this week talking about leadership. This is one of the charts that we use to find ETF leaders relative to the S&P 500. So what we're looking at here is the emerging markets ETF EEM relative to the S&P 500. When the ratio here is rising, EEM is outperforming SPY or the S&P 500. This is your bullish look, price above both moving averages, blue above red, and the slopes of all of them pointing in a positive direction. This is what your bearish outlook looks like, just the mirror image. Price below, slopes down, blue below red. You can see EEM did outperform the S&P 500 this week, but from a trend perspective, it still has a lot of work to do. This still has a bearish look to it. Where we are now, we track 130 something different ETFs. So we're looking at gold, silver, commodities, every major country, every major region of the globe, every sector. We know where the strength is by paying attention. Where the strength has been and remains is in the United States. Every ETF in the list that has a healthy looking chart like this that's made a turn or is already in a bullish uptrend relative to the S&P 500, every single one there's no exceptions. They're all in the United States, and they tend to gravitate around mid-cap, small-cap, banks, technology, broad market exposure like a VTI or an SCHB. Healthcare still looks pretty good, and consumer stocks have been leaders, but they've been a little bit weak the past few weeks. The point of showing this is if EEM can turn and look more like this or this, it will tell us that the laggards may start to lead, and that's where the real opportunity would come if the market can take another leg up. So it's something that we're monitoring on a daily basis, and we'll keep you updated on Twitter. We'll go through the charts quickly this week. Why? The models use every chart that we're going to look at, and we already know from looking at the models that roughly 94% of the things we monitor and look at, which is a very broad brushstroke and numerous indicators and charts and moving averages and ratios, 94% of them roughly are bullish. Daily chart of the S&P 500, point of the exercise, 50-day moving average, positive slope, price above. 200-day moving average in pink, positive slope, price above. Every moving average that we monitor on this time frame, price is above them all. Price made a higher high, and the slopes are all up. All bullish. And let's move to the next chart. Daily chart of the NASDAQ, 50-day slope up, 200-day slope up, price above both. The intermediate term trend is bullish. The long-term trend is bullish. Those of you who follow us on Twitter will remember here we noted in late April that the 50-day moving average, instead of rolling over here, was turning back up. Why was that important? It told us that the bullish intermediate term trend appeared to be staying intact. That was a good signal. You can see here that the NASDAQ has done quite well since we tweeted this comment back in late April of this year. This is kind of a noisy chart, but also one that we've tweeted. This is now just the Dow daily, 50-day, 200-day, 50-day, slope positive, price above, bullish. 200-day in red, slope positive, price above, bullish. If we get a Bernanke/Fed pullback, we have a Fed meeting next week, we potentially have support from three areas. A, the 50-day moving average here on the Dow, and this also applies to most major indices now. B would be this resistance and support trend line here. Resistance, support, resistance comes across in this area. Resistance, resistance, breakout. All of these intersect in this area. So most major indices have support relatively close by if we see weakness. This chart we've looked at in the past. Market breadth, NYSE new highs, stocks making new highs minus new lows. Black is good. Good things tend to happen when this is turning up. It has turned back up. As long as it looks like this, it leans bullish. This is also included in our models. Weekly S&P 500, good things tend to happen when the slope of the 22-week is positive. Slope is positive, price is above. Good things tend to happen when weekly momentum remains in overbought territory. We're still in overbought territory where good things tend to happen. How you use all of this, if you move out of overbought territory for this one indicator, it's a yellow flag. As long as you remain in it, we're healthy. We're still in it. This is the long-term support and resistance chart we've looked at numerous times going back to 1999. This is a monthly S&P 500. Resistance, resistance, breakout, still holding. As long as we're above the blue line, it leans bullish. Same chart we just looked at now from a weekly perspective. Bullish breakout, successful retest of the blue line, followed by a higher high. All of those lean bullish. As long as we stay above the blue line, it's easy to lean bullish looking out weeks and months. Weekly S&P 500 update to the chart we showed last week. We had a bullish breakout here in early July above 1667. As long as the S&P 500 holds above 1667, especially on a weekly closing basis, it's easy to remain bullish. A weekly close below 1667 would raise a yellow flag. Also note, Williams percent R, momentum, still in bullish and overbought territory. As long as it stays there, that's a good sign. We noted earlier in the video that leadership from an ETF perspective is almost exclusively inside the United States. One of the leaders for the past few weeks and months has been the Triple Qs, which we own a decent amount of. It's done well over the past few weeks and months. Point of the exercise, QQQ, weekly, relative to the S&P 500, appears as if this longer-term support dating back to the end of 2010, resistance, support, support, bearish break, bullish breakout, looks like there's almost two tests here. It appears as if we're passing this test. If we can make a higher high, that would be a good sign. Would also be a good sign if momentum, Williams percent R, can make a higher high and recapture negative 20. Similar to the Triple Qs, small caps is another leading ETF, IWM, within the United States that we own, done well for us. You can see this is a bullish look, price above, blue and red, slopes up, blue is above red, momentum bullish. As long as this chart looks this way, good things tend to happen. We'll close this week's video with the CCM Big Four, which is used in the CCM correlation model, which feeds into the master CCM market model. We looked at the spreadsheet. If you remember, That model, or this model, the correlation model, tracks numerous charts and numerous indicators. And we also said that 94% of the indicators and answers to the binary questions were bullish. So you can pretty much guess the CCM Big Four, they look good. Price above, slope up. S&P 500 in isolation still has a bullish look. As long as it maintains a bullish look, we'll err on the bullish end of the spectrum. Chart 2 of the CCM Big Four, risk on relative to risk off. Everything that we just said about the S&P 500 chart applies to this weekly chart. Maintains a bullish look. Momentum from a weekly perspective is still bullish down here, Williams percent R. This is chart 3 of 4 of the CCM Big Four. This helps us answer the question, would I rather be in stocks, SPY, or $SPX, the S&P 500, or would I rather be in bonds, the AGG Aggregate Bond Fund? This is I'd rather be in stocks, bullish. This is I'd rather be in bonds, bearish. Current look is bullish. Momentum, weekly basis, also favors the bulls and remains in good things happen territory. If something changes, which it may on any one of these charts, we're willing to be flexible and change with the markets. The way you use these models, as long as things look bullish, you remain bullish. When things start to change, you start to slowly step away from risk. Finishing up the week with JNK, riskier bonds relative to more conservative treasuries, TLT. This is what risk on looks like. This is the stock market up here. This is what risk off looks like. This is the stock market up here. This chart carries a lower weight in the correlation model because, as you can see with the big head fake we had here, sometimes this ratio gets weak and the stock market holds up. It's relatively rare, but it happens. Current look, bullish. Momentum is currently bullish. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.